Hello, everybody. This is John Peterson, and thank you so much for joining us here at Washington REIA, March 2023. Thank you so much for joining us. We're going to give everyone a little bit of time to kind of get on board here as you come on into the classroom, if you will. Feel free to say hello to everyone, and we look forward to a great night of talking. As I was sitting here, I was just thinking because you sit here for 2 or 3 minutes before you see that little red button in the corner that says you're live. And I thought, man, we've been doing this a long time. This is 20 plus years that we've done Washington REIA meetings here in Maryland and Virginia. So thank you so much for joining us every month. Tonight, we're going to have a great discussion. Boy, it almost sounds when I was doing my notes, kind of history repeats itself. So if you've been around a while, some of this stuff is going to sound very, very familiar. Good to see Jim. Thanks for tuning in. Gloria, hope you're doing well. Still working? Good. Feel free to give me a call. We need to circle the wagons and see how everything is going for you. Thanks for joining tonight. Hopefully you'll get Gloria a little bit of good information out tonight that you can certainly apply to your business. But as I was saying, as I was sitting here kind of waiting for that little red button to go live, I thought, wow, tonight's talk is the banks are closing, now what? And it feels like I've been doing this long enough now where things are constantly coming kind of in circles. So it's not that difficult to look back and see what's happened and see what may happen here in the future. So we're going to be talking about that more tonight. I want to start out tonight. Those of you that know me know that I'm a huge sports fan. I love basically all sports, but this time of year may be my favorite. When we were alive for many, many years, we always talked about March Madness, and we're right in the middle of it, coming off this fantastic weekend of basketball. And those of you that hopefully filled out a bracket, I'm sure they're probably all upside down, but it's still just, for me, just kind of a great time of year to watch basketball. My alma mater, Furman, actually had the first upset of the whole tournament, beating University of Virginia in the buzzer. A text was going crazy from old friends from Furman checking in. And then, of course, we got blown out in the second round by San Diego State. But still, it's just a lot of fun this time of year. So hopefully if you're into sports, you're into basketball, you're enjoying some of that. Even if you're not, hopefully you had a chance to fill out a bracket, maybe in the neighborhood or at work, and are enjoying some of that this time of year. So tonight, again, we're going to be recapping a few things and then talking primarily about what's going on with these banks. And those of you that join us, any comments that you have, any questions, you want to add anything, I don't stand back and I've been doing this for a long time, but I'm certainly not an expert in banking. I find it fascinating and interesting, and I try to kind of project how it can affect my own business, which obviously is similar to many of you joining us on a monthly basis. And we try to give you maybe a few ideas here or there on how you can kind of maybe protect yourself, and maybe more importantly, how you can seek out opportunities when things are going on all around us that definitely do affect us, whether we know it or not. So that's kind of one of our pillars of Washington REIA, and we haven't talked about that too much, but one of the pillars is that we end these meetings and these talks. Our goal is to give folks that are listening, either live or recording, just, nuggets, if you will, just small pieces of information that can be applied to your current business that can help you out. We don't try to say that we're the experts in all of this. If I've learned anything in my 25, going on 30 years of investing in real estate, is that really nobody knows anything and nobody knows what's going to happen around the corner. But it is interesting for us to talk about it and certainly pay attention to it, because it does, as I said, have an effect. So let's just recap January as we start out. And as I said, as we go along, if you have any comments or questions, feel free to hit up the comments page, and I'll take a look at those. And if I can answer those for you, I will. Even if it's something as simple as you're rooting for Gonzaga in March Madness, any kind of comments that you want to make are welcome, and we'll keep this conversation going. Recapping just a little bit what we were trying to accomplish in this first quarter of Washington REIA. As you know, kind of in that November, December timeframe, I've said this a number of times, we kind of sit back and try to plan out our business in kind of quarters. And when Justin and I, who filled in admirably last month, I'll get to that here in a minute, when we sit down and figure out what can we kind of set up here for Washington REIA, what are people what's the feedback we're getting? What do people kind of want to hear about? And we try to really make this first quarter a little bit about going back to the basics, going back and really helping people that are getting going in the business or have been kind of around a little bit and want to kind of jumpstart their business, kind of maybe get to the next level. And so in January, we started off with something very, very powerful. And I've seen the results already with a number of people, but also somewhat basic. But if you don't start with the basics, if you don't start with the fundamentals, you're never going to get to where you want to go. So in January, we really talked about focus, and we talked about kind of focus on maybe the smaller things. And what we meant by, and what we challenge people to do, is really come up with at the beginning of the year, what technique or strategy did they want their business to revolve around? What was that one thing, if you will, that you wanted to focus on in 2023? And then taking that, and again, that could be wide ranging in the real estate investment business. For me, when I first started, it was buying, renovating, and selling property. And that's kind of been the theme of my business for the past 25, 30 years. And then offshoots of that. But my focus and what I wanted to learn and what I wanted to study and what I wanted to get good at was buying undervalued properties, renovating them or bringing them up to the neighborhood value, and then reselling those and hopefully making profits along the way. The next thing we talked about is then once we had that strategy, whether it's wholesaling, buy, renovate, and sell, buying rental properties, buying notes, whatever it might be, being a good real estate agent, being a good mortgage broker, whatever it is, that specific area that you kind of wanted to be or showcase of your business. Now, that doesn't mean you can't do other things, but we want to narrow down exactly what you were looking to do this year. We also talked about then focusing on a smaller targeted area. And the reason for that is that once you do that, and once you really focus in on, let's say, even a zip code, now it has to be large enough for you to generate income, but maybe a zip code or a county, or if you want to go a little bit bigger, a state, but really focusing in that geographical area and then honing in on those marketing strategies, honing in on building that team, honing in on networking in that area to become an expert, to become someone that knows values, someone that knows attorneys in those areas, someone that knows that direct mail works there, knowing how neighborhoods are split up in values. And so it's very, very important to do that. And I hope a lot of you did that. And it sounded like some of the feedback we got that people did also, that actually did do that. So when we asked the little questions, what were your goals for 2023 and what kind of properties kind of were you looking for? And so hopefully we accomplished that in January, because that kind of sets up our entire year. If you're scatterbrained, if you're thinking about notes, if you're thinking about buying, renovating, selling, if you want to wholesale a piece of property, if you want a rental, but you're not sure you want it in the entire DC metro area, but maybe in North Carolina. Oh, you heard Florida was good. And then you hear all taxing properties in Oklahoma are really, folks, you're like a ping pong ball. You're just bouncing all over the place. You're never focused, targeted, and you're never going to make progress to your ultimate goal, whatever that may be. And for most of us, that's making money and long-term wealth and net worth and so forth from a business strategy, business-oriented operation. Okay. And then what, if anything, have you done thus far to find those properties? And we kind of took all that and we boiled that down, and hopefully we gave you a little bit of direction. February comes along, and we had another a good talk, prepared. I spent a little time on it, and that Monday morning I woke up and I felt horrible. And I gave Justin the heads up at about 11 o'clock in the morning, and I thought, Justin, I know you need a little time to prepare, but I am not feeling well. Just had that classic winter flu and just felt horrible, could barely lift my head. And the thought of coming on and doing a 45-minute talk just was not going to happen. So Justin filled in admirably. He brought in Gary Green. I'm not sure if Gary's on with us or not. Tanya, gosh, good to hear from you. Magdalene, again, thanks for joining us. Gary Green came on, and from what I heard and what I saw, wow, William Nash. I'm sorry, I paused. I get to see some of these as they come through. William Nash first met and worked with you in 1995, 96. We were just children back then, William. We were just babies. What's happened to the last, 27 years? So you were early in my career. Hopefully I did you well. If I didn't, don't say anything. If I did, feel free to comment. In February, Gary Green, local investor, came on with Justin, and they batted around different ideas. And Gary shared with you some of the things that he's been doing. Again, Gary Green, another very successful investor that's been part of Washington REIA for years and years, very focused, focused on buying, renovating, and selling properties. And he has put together a nice team of partners and people that support his business. And again, that doesn't mean that Gary doesn't own rental properties. That doesn't mean that Gary doesn't work with his self-directed IRA. That doesn't mean that he is not into other aspects of real estate. He's also a realtor, but his focus from an investment standpoint is buying, renovating, and selling properties. And I think that was a good meeting, and I appreciate him coming on board and sharing that. His experiences with you, because his are very typical. His are typical of people that have committed to a specific strategy, committed to a geographical area, built it up over time, and he's done extremely, extremely well. All right, so that's kind of our recap. January was that focus. February went off course a little bit, but Justin, thank goodness, came in and rescued it and did a great job with Gary and talked about different aspects of real estate investment there with you all that weekend. This month, our schedule was kind of talk a little bit more about property valuation, some marketing, some things of that nature as you built this specific strategy out. But folks, the headlines just grabbed the attention of all real estate investors and really all consumers or all Americans, if you will, or maybe everyone around the world, because we saw some headlines that were a bit scary. We've been on kind of this roller coaster here where the Fed, as many of you know, and again, this is not going to be an economics lesson because I couldn't teach you economics in a simple way on any level, but it is important for us to understand what's been going on so we can kind of take a look at it and figure out how we can position ourselves to take advantage of it. And what happened in the headlines was that here we go again, another bank was failing. And the Fed had to step in and support that bank. So I kind of wanted to talk to you about that. And then as that started happening, you saw, again, kind of a free-for-all, some other banks starting to be kind of close to teetering and collapsing and so forth. So we want to talk about that. But we've been on kind of this teeter-totter, if you will. The Fed has been raising these interest rates. And folks, it's been a wild ride. Last June, we still could get a rate of around 3.5% on 30-year money. That's 30 years at 3.2%, maybe lower, maybe a little bit higher, depending on your situation, but tremendous capital. All of a sudden now, as the fall goes on, as the Fed raises rates, long-term interest rates react, and they start going up to 5, 6, even in the low 7s there in December. And what you saw was just basically the real estate market pausing or stopping. I have talked to countless investors, countless title companies, mortgage origination companies, different people in the business that thought, man, last fall was tough. It was rough. And folks, it had to be rough. We went from 3% money to 7% money in a span of 6 months. That's going to disrupt the real estate market. Now, fortunately, for me and for other investors, there was some properties that kind of got caught in that whirlwind, but properties were still selling, albeit slower, maybe for not the height that we anticipated when we bought, but a lot of us were able to get out, still make a profit and move on. But there were a lot of people that thought, man, this is rough. I talked to one of the larger title companies in Maryland, had a settlement with them, and he told me that it was the worst since 1982. They've been around that long. He said, it is tough. We are cutting different people in the office that we don't need because we don't have the volume. Our next step is we're going to furlough people, meaning we're only going to ask them to come in 2 or 3 days a week because we don't have the volume. And then if it doesn't pick up, we're going to have to start laying people off. So we're on this teeter. The economy still seems to be okay. Job growth is still okay. Interest rates keep rising. The real estate market's at a standoff, right? Sellers aren't selling because they're not giving up that 3% mortgage. Buyers aren't buying because they can't afford the 7% mortgage. So we're at the standstill. And for an investor, it's been fine because there hasn't been any supply. So if you have houses you want to wholesale, if you have houses that you're renovating and selling, if you're reasonable, you can move these properties. And I've seen that in my own business, able to move properties at a level that's still fine. Things are not sitting on the market for months and months and months that we can't sell. It's just a supply demand issue. But we're at this standstill. Folks, I live in a neighborhood of probably, I'm guessing, maybe 400 or 500 houses over a course of 2 or 3 neighborhoods. And literally we're at mid to late March. And there's literally one house on the market, one house on the market. So there's just no supply out there. So now all of a sudden, the headlines come along. And again, as you guys have comments or questions, feel free to hone in. But as the headlines come out and say Silicon Valley Bank collapsing, closing, what's going on? Where's Silicon Valley Bank? What's going on with this bank? And folks, this is what leads us to our discussion tonight. The difference between 2008, the last banking crisis that almost took us all under, and now, okay, it's stark. The differences are stark, and this is what it is. Basically, in 2008, we had massive loan defaults, right? Securitizing all these loans that were basically funny money. Everyone was getting a loan. And all of a sudden, these loans were defaulting. People weren't paying on these loans. They were going underwater. The value of properties was cascading down, and the banks had massive loan defaults. Now, there's 2 areas of concern for bankers. It's not loan defaults as much. It could lead to that. But right now, it's interest rate risk, right? We just mentioned the interest rates doubled in the last 6 months, and the liquidity risk. So what does that mean? Let's break that down here. Interest rate risk, liquidity risk. The interest rate risk is very basic. As yields on securities go up, as interest rates go up, the prices of those securities or long-term debt, bonds, assets go down. And so as we have a rapid rise in rates in this short time, the market value of that previous issued debt, especially long-term debt, goes down. So these banks, these regional banks, I read somewhere where it's $620 billion of unrealized losses on their books. Folks, just to have it on their books, that's fine. It doesn't matter. But what's happened, is when this Silicon Valley Bank had to start selling some of these long-held assets, all right, their risk management was horrible at that bank from what we've read. The management had no idea what they were doing. But as they sold these long-term debts to create capital, they had, like they said, $1.8 billion of loss. Now, all of a sudden, they went and started raising money, raising equity, raising capital to offset those losses. Depositors get wind of this. This is public knowledge. And that particular bank had tremendous amount of uninsured deposits, meaning the federal government only insures up to $250,000 of cash in a bank. And for most people, that's fine. But this bank was catered or tailored to people that were starting up these tech startups. And they had millions and millions and millions of dollars in this bank. In fact, I read where the bank required them to have their operating accounts and so forth in that bank if they wanted certain benefits from that bank. So that happens to us too. When we get a loan for commercial property, they want our rents in that bank as part of the loan commitment, if you will. So now all of a sudden, these folks that are owning these businesses are going, oh my gosh, this bank is teetering. They're raising capital. They might be in trouble. And so they run to the bank and start taking out their money. And it's just a cascading effect. And so now all of a sudden you have this bank that's collapsing with all these millions of uninsured deposits in that bank. And can you imagine sitting there on a Saturday or Sunday? Forget March Madness. You're talking about your business's viability, payroll on Monday or payroll the following Friday. They were concerned because this bank was collapsing that all that money, millions and millions of dollars, was going to vanish overnight. Vanish. Man, that's a long weekend. And they were scrambling to raise capital and scrambling to figure out what a stopgap was so they could continue to run their businesses that following week. Well, those of you that have been following this in the news know that the Federal Reserve or the Feds, FDIC, came back and they backstopped not only the insured funds, but the uninsured funds. And folks, whether you think that's right or wrong, they did it because they wanted to stem just a cascading effect with all these other banks. Because imagine, now I believe Silicon Valley Bank is somewhat unique. They cater to a specific clientele. But then come Monday, and then you have this other bank, Signature Bank up in New York. All of a sudden they're teetering. People are rushing in to get deposits. So folks, all these banks are exposed to this liquidity crisis and this interest rate risk. And if this starts cascading, then we can have another 2008 on our hands. Now, the Federal Reserve, FDIC, has come up with this backstop, if you will, and they're lending money to these banks to kind of, make them whole, if you will, and they're securing them against higher asset values, okay, things that have value. That's what's kind of happened, if you will, with SVP. Those depositors got spooked and they began to withdraw money, and that starts a cascading effect. Now, a couple other banks that are in the news: First Republic in the South, they're having issues, and then some of you read today where I always say this wrong, Credit Suisse, the bank in Switzerland, they're teetering. 165-year-old bank. But now they said that has nothing to do with interest rates, although it's having an effect, and liquidity having an effect. It's really more years and years of horrible decisions, poor management, fraud, different things that are going on in the bank. But again, the Swiss government has come to their rescue and back them up, because we can't have these banks failing, if you will. And on the flip side, we don't want just 4 banks in the United States. We don't want JP Morgan, Chase, Wells Fargo, Bank of America. We want these regional banks. They make the bulk. I think they said 60% of home loans. They extend credit to businesses. They extend credit cards and lines of credit and automobile loans and all the things that make our economy go. So we need these smaller regional banks. We don't want just to have 4 banks in. So, okay, Marvin, purchased by UBS for 42 cents in the dollar. There you go. Okay, was that today? I didn't see that, Marvin. If you want to enlighten us, that would be great. But yeah, I mean, this is great for UBS. Probably got a great deal. Probably manage those assets better and come out doing very, very well. So again, that's kind of what's happened. Has been pressure on selling these assets that are underwater. Think of it, $620 billion. Now, again, this happened to me. This has happened to a lot of investors back in, 96. I go all the way back to when William Nash and I were doing deals. Okay, Marvin, over the weekend. I didn't read that today. Thanks for that. Back in 95, 96, where the market wasn't great. I had owned a house, my first house in Silver Spring, actually in Wheaton, with my wife, and we wanted to sell that house, use that money or that available credit to get a mortgage to buy the house that we're still in today. Now, we couldn't buy that house when we started looking at the numbers. Again, I was early on in my real estate investment career. When we started looking at the numbers, I couldn't sell my house because I was going to lose money. It wasn't as much as equity, but just the transaction costs, realtor fees, transfer recordation costs, different costs was going to, probably make me have to come to the table. Can you imagine that? No one comes to the table anymore, but I would have had to come to the table with about $15,000 to $18,000. And so if I had to do that, I didn't have the money to put the down payment on the new house. And so I was kind of stuck selling undervalued assets. Now, again, I had the ability and the foresight and the blessing, if you will, to be able to rent that house and take a very small negative cash flow. I owned that house for 5 or 6 more years, about 6 years. The value went up to the point where I could then take that asset, do a tax-free exchange, and I bought a house in South Carolina that I still own today. I bought that house in South Carolina, I think, for a little under $400,000, and it's worth 1 point whatever today. So again, if you're not forced to sell the underwater asset, if the banks aren't forced to sell, we're fine. But as these depositors make these run on these banks and they're forced to sell undervalued assets, you're in trouble. I had another one in 2008. I had a rental property that I kind of wanted to sell. I was losing money on it. But when you factor in everything, I was going to lose money. And I thought, well, I'm going to just do, a rent option so I can get my rental rate up a little bit. And I could hold that property. And again, thank goodness I did. I literally just sold that property in the height of the market in 2021, did a tax-free exchange, bought another home, sold a townhouse in Gaithersburg, bought a home in Anne Arundel County, have 1,000 plus rental cash flow in Anne Arundel County, about 80,000 more equity built in, plus the equity I had in the townhouse in Gaithersburg. So if you can hold through recessions, if you can hold through down times, you're fine. And now with all this cheap mortgage money, if people can hold on to these homes, hold on to the rentals, hold on to their single family homes, they're fine. But if you have to sell is when the pain really starts coming in. So that's really kind of what we have to watch out for. So, what's happening. So that's kind of what's happening with the banks, if you will. And what are the results? Okay. The results from the experts. And if I've learned anything, there are no experts. Nobody knows what's going to happen over time. They say they do, and they guess, and some guess right and some guess wrong. But certainly what it seems that's going to happen is that lending standards are going to be tighter, and there's going to be less credit on new originations, right? So going to get an automobile loan, going to get a new house, going to get an equity loan, home equity loan, all those things are going to be tighter, and there's going to be less of them because the bank's reluctance to take this risk at this moment. And what does that lead to, folks? It leads to recessions. And that's what I said when I first started. We're on this teeter-totter. Okay, are we going to walk through this and be okay? Are we going to have what they call a soft landing, where kind of it's going to be a little slow for a while, but we're going to kind of be able to soft land and then grow again? Or are we going to have a full-blown hard, buckle your belt and massive job losses, and you're going to see more foreclosures and different things, call a hard landing? Now, a lot of people think this new bank headlines, it might lead us to a harder recession. Okay. So ask your questions. It's happening on Wednesday. Is the Fed going to continue raising rates to combat inflation? Are they going to pause and kind of see how all this stuff plays out? Or are they going to stop raising rates? So we're going to have to see again, but what that means for us is opportunity. And that's what we want to talk about here as we go forward. Any questions, comments, feel free to weigh in. As you can see, our audience is smarter than the presenter, with Marvin letting us know about Credit Suisse, and I appreciate that. But where are the opportunities for us? We hear these things. Now, again, if you're just starting out, okay, great. Go back to the beginning. Go back to January. Figure out your strategy. Figure out your geographic location. Start thinking out your marketing budget. Start building out your team and your network and get going. This is a great time to do that. Ms. Brown, hopefully the weaker banks will cause Mr. Powell, the Fed chairman, to slow down on the interest rate increases. Amazon announced another round of layoffs. William, that's an interesting comment you made about Amazon. Some of these bigger companies, remember, they hired when we were running hard here through the pandemic. So a lot of them were bloated, meaning they had too many workers, and so that's what I think is happening with some of those bigger companies. But you need to watch that. You need to watch those things. And Karina, for me, that's a hope. I hope they pause a little bit, because let me tell you, and it will happen. I'm not sure when, but as rates come down, and my guess is somewhere in the mid fives, when you see rates down in that mid 5 range, watch out. Housing market is going to come roaring back, because folks, there's just no supply and demand, right? The velocity of the real estate sales you're going to see is going down year over year over year. There's just not a lot of activity going on, but there are buyers out there that want to buy houses. There's new families being formed. There's new life changes. People want to retire. People want to downsize. People want to move up. People want to buy their first condo. I mean, there is that in there. Buyers can't afford it, and sellers don't want to sell right now. But as that loosens up, I think you're going to see some tremendous velocity in the housing market. So where are opportunities? Okay, let's talk about that. And this is where I said, boy, it seems like, just go back to the playbook of 08, but it's a little bit different than 08. All right. It's a little bit different. So this is what I would do. I would go back. Again, I keep going back because we try to tie this together. We got a great question here. We'll look at that in a minute. I go back to January and figure out, okay, what's my strategy? And then what are the opportunities within that strategy? And I'm going to get to that in a minute. Let's read Ms. Brown's questions here. We have some hot markets. Single family home in Fairfax are getting 6 offers, 500, 50,000, 100,000 above list price. Prices are matching last year's high prices. We just have to find the right markets. The condo market is slower if you're trying to find a home for a buyer. Yeah, that's absolutely true. And the reason of that, in my mind, in my opinion, is because there's just no supply. There's no supply. Okay. And you have, 5 or 6 buyers that are looking for a house in a certain neighborhood, and one pops on the market that's reasonably priced or in reasonable condition, it will get bid up. There's no doubt. So let's go back to those strategies. Let's just talk about one. What are some opportunities maybe in the buy, renovate, and sell market? Well, we said the result of some of these banks is going to be tighter lending criteria. Okay. So it might be a little bit harder, if you will, for people to get mortgages. Okay, for when you resell these houses. It also might be a little bit harder for you to get lines of credit and different things you might need in order to support your business operating capital. And maybe you're working with a bank to raise capital to buy some of these homes. The first thing I would do is spend some time in financing, in the area of financing. Study that, learn creative strategies, learn how to raise private capital. Justin's going to come on here in a minute when I finish this and talk about a creative strategy they use to sell his mom's house. So learn creative strategies. That's going to be important as we go forward. Number 2, look to have different exit strategies. That's always such a great strategy to have in a slower market. So when you buy, renovate, and sell, and folks, in some markets in this area, it's tough. I always go back to Petworth. If you have a $900,000 house in Petworth, and your strategy is to buy, fix it, and sell it, you better sell it. Now, if you can't sell it, what do you do? Well, could you rent it short term? Maybe you could do 1, maybe you could do 2, take a little negative cash flow, possibly, and weather the storm. But I'd be very, very careful with some of these markets, some of these higher price subsections of the DC area market when you're buying, renovating with the intent to sell. But if you have some creative strategies to sell, if you have some creative financing to sell, you're better off. But more importantly, if you have a couple exit strategies. That's why a lot of my buy, renovate, and sell properties have always been in working class first-time home buyer neighborhoods. I find those have multiple exit strategies in case the market just falls down. Because folks, some of in 08, 09, I had 33 hard money loans. I was a lender that went belly up. Okay, so I learned real fast how to, learn from that. Because it was a long slog to get out of that. Okay. So you learn sometimes when you go through some of these experiences. And then finally, with the buy, renovate, and sell, the way to protect yourself, okay, and way to look for opportunity is know your values. That's why I say shrink your market. Know your values. Know what houses are selling for. Folks, they're not. Now, Karina said that they're getting back to those highs of last year. Most markets aren't. Okay. And don't count on that. Because if the merry-go-round stops, trust me, you will not see those values that you saw last April, May, June. You just won't. So you better not predict on your buy, renovate, and sell, I'm going to get 600 grand because I saw a house exactly like it that last May got 600 grand. You better come off that a little bit. And I'm just trying to protect your downside. In recessions or in times of uncertainty, which we're in a little bit, you want to keep continuing building your business and looking for opportunity, but you want to protect your downside. You don't want to be a victim of this market and look up in October, November and having to file Chapter 7. Okay. So this might not be your bet. Maybe it is, maybe it's not. It's definitely an opportunity time. Okay. But you want to protect your downside. You're a wholesaler. That's what you've decided you want to do. Where are some opportunities? You need to identify those strong buyers in your database. So when you're wholesaling out, you don't want weak buyers. You want strong buyers, whether those are investors, homeowners, wherever you're selling to. Make sure you qualify for good, strong buyers that have available capital that can close for you. Look to other sources outside investors, meaning look for landlords. Look to landlords that want to add to their portfolio. Maybe you're in a neighborhood where rental properties make somewhat sense and you could wholesale. You get a list of investors in that general zip code and market those wholesale properties to those investors because they're going to keep them. They're going to keep them as long-term rentals. They're not going to turn them over real quick. So they're willing to pay a little bit more than that investor that's looking to renovate and sell. Look to owner occupants, network with realtors. Owner occupants, I do that quite often where I close on a property, we clean it up. We don't do a whole lot of renovation. We clean it up and we market to handymen. We market to owner occupants that want to go in. They're okay with the kitchen. They can live with the bathroom, even though it's dated. They can paint, they can carpet, they can landscape, and they buy properties at a very good value. And we still make money and move on. That's the other thing in buy, renovate, sell. Maybe the opportunity now is because there's no supply. When you get a good property, don't go crazy in renovation. Do less. Give them value. Sell value right now. That's what people want and are looking for. Let's talk about rentals. I'm going to bring Justin on here in a second. Identify where the opportunity is, strong cash flow markets. Now's the time. If you understand financing, if you understand private capital, this is the time as we go forward. Keep your eyes and ears open to pounce. I have a couple of markets in North Carolina that are strong, that they've turned back strong. I got one great market in Florida that's turned back strong as a cash flow market. Learn those, study those, find those, network with those, okay? And take advantage of those in these times. Raise that private capital. A lot of you know, in 2008, when the market collapsed, I was up to my ears and elbows trying to solve my issues and get out of some of my loans and keep my business going and being prosperous. But I also knew it was a good time of opportunity. And I just begged and pleaded and breakfast and lunched with some of my long-term investors saying, now is the time. Let's put together a fund and buy some rental properties. Well, finally, in late 11, 12, I convinced two of them that this was the time. Even though I thought 2 years earlier was a better time, they came aboard. We put together some capital. Our goal was to buy 100 of them. We were late. We identified 22 of them that made sense. And we bought them in a year and a half during that about 12, 13, early 13. And we just literally sold the last one in January. So we held them for about 9 years. The goal was about 10 years. We did a little bit short of that. And we did wonderful on this. The portfolio more than doubled in value. Cash flow was good back then, and it will be again. Capital was plentiful. And so that was a time to strike, and we made great money. And it was wonderful for me. I got equity on the back end. I got monies to find the deals. I got money to manage the deals, got money to renovate the deals. I mean, the investors got cash flow. They got equity on the back end. It was great for everybody. Those times are returning. Okay. So look for those. Now, again, if it doesn't play out like that, okay, you don't buy 100 of them. You only buy 20 of them, or you buy 2 of them, or you buy 1 of them. You buy 1 now for college education. You buy 2 now for retirement income. But now's the time to start seeking out those markets and looking for those opportunities. Okay. When the banks are struggling and when people start getting worried about recessions, now's the time to have your eyes and ears open and really looking and network and get to know people and market those properties. Justin had a recent deal that he wanted to kind of talk about, because I thought it was a great example of how you can use creative financing to sell properties, and also how you as an investor need to understand how you can raise capital to buy properties. So Justin, why don't you just share with them that recent deal that you all did with your mom's house?
All right, good. Thanks for the little introduction there. This is a property I was thinking about talking about last month, and Gary and I got a little carried away. We had some good questions come in, but this is a really good example of being a little creative, maybe helping somebody in their very specific situation figure out what it is that they want. In this case, I'm talking about a property that my parents had owned. Some of you know my father had passed away about 6 years ago now. This was a home that there is a in-law suite in the property as well. So my grandmother and grandparents had actually lived in the basement. My grandmother was the surviving in-law that lived in the suite. She passed away at the end of COVID. So last year, my mom basically spent the 6 months or so kind of packing up the house and getting ready. That was her goal all along. She said she just couldn't sell the house until my grandmother wasn't there to be with her anymore. And by the time December rolled around, the house was finally ready. For those of you, maybe you can all weigh in here a little bit on this, but how many of you think that December is a great time to try to sell a property? wait for a few seconds here to get a little bit of feedback. But most people think that December can be a real challenging time. Most people are stepping away. They think they're all attending holiday parties. What are you going to be doing? You're going to have to wait around until the spring market hits. The reality is, yeah, so here we go. William, you know that December can actually be a good time of year. Love selling in December, Russell. Exactly. So December can be a really great time of year. So we actually listed this property the first week in December, and within a couple of weeks, we had somebody that came in and said, "Look, we understand after talking with your agent that you're actually open to owner financing. Here's our situation." And this is where you got to take these on a case-by-case basis, because my mom's actually interested in income. We talked about just renting the property. John, you've gone through this a couple of times. Do we rent it, get a little bit of income? Do we try to sell it? What's the terms that we have to do with people? Sometimes it can be a real challenge, especially once you get a credit report back from somebody, because a lot of times people are coming in, they want to owner finance because their credit's not so great. So taking these on a case-by-case basis is exactly what you need to do. In this case, this gentleman was a veteran. He was a Army chaplain who had just retired. He was moving to the Greenville area, and he wanted a property that was going to be not too far from his in-laws. So his wife is walking through the house. I'm talking with my agent a little bit later on, and he said, "Listen, these people absolutely love the house. It's perfect for them." The house needed a little bit of work. So my mom had been in the house for the last 6 years. There's a little bit of what we call deferred maintenance, right? There's a couple things that need to be fixed. These people came in and said, "Look, we want to kind of make this our own. We're actually thinking of having our in-laws move in with us. It's a perfect house. But here's our situation. We have not, we're not going to be able to purchase this through the VA loan because we just finished a renovation. We're not going to qualify until September. So would you be interested in financing this?" And after seeing a contractor report that we had gotten from one of their previous renovations that they do decent work, the spouse of the Army chaplain was actually a licensed contractor, general contractor. So all of these things just kind of came together for us. It was absolutely perfect. My father was a veteran, so we felt really good about passing this home on to another veteran, and same type situation. The in-laws were going to be close by. So now it came down to price. And of course, they came in and put down just a couple of notes here just to kind of help people follow along here. But I've rounded these off just a little bit. So let's say that the sale price of the house is $500,000. Now, John, you give me a little bit of feedback. Was $25,000 down a little too little to take in this case, or do you think this person was qualified to?
The great thing about real estate is there's no right or wrong answers, right? So it's what both parties feel comfortable with. So if your family was comfortable with $25,000 is enough money for most people. That hurts. So you want to get it to a point where, if you're accepting owner financing, that, it hurts a little bit. So, all the other things that you've told me about the deal, $25,000 down, sounds like they're not going to walk away from that.
Yeah. So that's exactly what was happening here. So with 5% down, they're also going to be putting they estimated $25,000 to $40,000, depending on what they do with the house. Russell's saying 5% works for him in this case. And again, I'm dealing with somebody who's coming out of the military. We understand what their situation is. They just renovated a property themselves. They're trying to get out of that. They were at the time only asking for 9 months. And I've been in this long enough. And for those of you that have been in this for a decade or more, you know that you take the best intentions. And if you double that time period, let's go ahead and plan on that and be able to live with that as what the actual reality may be. So that's what we did. We said let's do this instead of just saying 9 months or even a year like they were asking for. Let's extend this out to 2 years. We kind of see that the market's a little shaky right now. The stock market, the Fed's starting to raise interest rates. We're all mature investors at this point. This could go sideways for a little while. So why don't we give you 2 years, and we'll go a little easy here on interest only payments. So at the end of the day, my mom is absolutely pleased because she's got a little bit of extra income. And on top of all this, she did still have an existing mortgage. So there's a complex situation here where if you look at a property, and I want people to understand, don't be afraid to do this situation yourself. If you've got somebody who has an existing mortgage, and especially if they got it in the last couple of years, you can go in and do what's called a wraparound mortgage, where let's say my mom had a mortgage on the home that was still, I'm just going to round off some numbers here, let's say $200,000. She can sell that property, and the remaining balance, the other $275,000, can actually be wrapped around her existing mortgage. So now every month, whatever the Army chaplain and his wife make the payment on the property, they're making her payment, and she has a little bit of extra income on the side. So she's got that for at least the next 9 months, probably a year, possibly out to 2 years. And if we get to the end of those 2 years, how many of you think you would be happy to do an extension on that loan? As long as my mom's property has increased in value, they've done good renovations into the property, even if the property has just stayed even, she's more than likely willing to say, yeah, let's go ahead and extend this. I'll give you another year. We understand where the market is. If the property's gone down a little bit in value or whatever the case may be, we cross that bridge whenever we come to it. Yeah. So Russell again saying, just go ahead and extend it. Exactly. So that's the plan for this property. It's great if we get out in September. She gets basically the balance. Everything gets paid off. But if things go a little bit sideways and have to be extended, that's okay too. We kind of cross that bridge whenever we come to it.
Exactly. And that just goes back to, as we said, as investors, when markets become, or the economy, let's say broader economy, when it gets choppy, okay, the investors that have a little more education, the investors have a little more creativity, the investors that aren't afraid to take a little bit of risk are going to come out very, very well. In fact, choppy markets are where most investors make the most amount of money. So when I say as we go into a recession, if we do truly go into a recession, and again, half dozen economists are going to say we are, half dozen are going to say we are not. But we all know that things are a little bit choppy now. As you learn and you understand some of these things, there's no reason for you not to do very, very, very well. All right. So as we go along, and again, we pride ourselves on trying not to keep you here too long, try to honor our time commitment with you. You know, I've gotten a lot of feedback really in the last, Justin may agree or disagree, I guess about 6 months, maybe 9 months, people asking us, you know, are we going to come back in-person meetings? Are we going to, continue to do these online? And our answer is sort of. How's that? We are going to continue doing these online, but in April, we are coming back. We are going to do a in-person event for those of you that are members of Washington REIA. But we don't really want to go back to the old, just feed you a sandwich, stand up, talk, and so forth. We wanted to change it up a little bit. So again, we talked amongst ourselves and hearing a lot of feedback from different people, and the overriding kind of theme, if you will, the overriding need of a community of investors, in my mind, and people that we've talked to, is what's missing from online and what's so valuable of in-person meetings is just network, right? Is just community, is that face-to-face meeting. It's meeting other people that are involved in the same business that you are, and then piggybacking off everybody's resources and knowledge and experience and expertise and backgrounds and how they got started and where they're going and what they're seeing and what kind of marketing is working and can I grab a cup of coffee with you, and all those intangibles that you get when you get together as a group, as a meeting. And we've been talking over the last few months about 23, being part of 23 for 2023, that I wanted and Justin wanted and our community wanted to have a really profound effect on 23 of you. And that sounds kind of silly, but we picked that number because of 2023, and really see some growth with those 23 people, and really see people that are kind of hanging around and wanting to get started to do their first deal, and folks that are doing 2 or 3 deals to really take off and start doing 10, 12, 15 deals. And for people that want 1 or 2 rentals, to get those 1 or 2 rentals, but maybe buy a 4 to 6 unit building, really see some growth this year and really push for that growth. And that comes from network, that comes from resources, that comes from education. And so we're going to invite 23 of you to join us in April for a live event. And that 23 people are going to be a cohesive unit as we go through the next X amount of months together, and really push each other and really strive to have a cohesive unit doing some deals. I'm going to invite some successful investors that I've worked with over the years to also join us as kind of honorary members, if you will. And they're going to be able to share some of their experiences and some of their resources and some of what they're seeing in the market. And tonight, I just want to, and you'll see in the screen, if you want to be a part of this, if you think this is something that you're interested, you want to be on the preferred list, like anything, like any small business, we don't have all the details quite ironed out yet. We got many of them though. And if you want to be on that preferred email list, so you can be the first folks to see this and to participate in this, let us know. On the screen, you can just text your name and your email. If you don't think I have it, I probably have it if you're in the database, but you can just text your name. And then of course I have your number through the text, that you want to be on this preferred list, that you'd like to be a part of this group of 23 people that we're going to see some tremendous growth in 2023. When I first started Washington REIA way back when, I'm not even going to tell you the date, I think it was 2000, 2001. And it was with my mentor, Ernie Kessler. And we talked about some of this, and we talked about, you know what, the most powerful sessions, REIA sessions that we've ever had, or the most productive. And when you think productive, sometimes that's dollars and cents, where deals are flowing, is when the group is small and when it's tight and when people can really get to know each other and know, you have a wholesaler in the group, you have a buy, renovate, sale guy in the group, you have a hard money lender in the group, you have people that know title attorneys. I'll share with you one of the most prominent wholesale real estate attorneys in the area. And folks, there's a lot of things that I don't share with you because I have a business too. Like you noticed, I talked about 2 great cash flowing markets in North Carolina. I didn't tell you where those were. I didn't tell you where the one was in Florida, because I do invest in real estate and profit from this. But in this group, you can open up a little bit and you can share some of those things. So if you want to be a part of this, let us know. We'll put you on the preferred list. And
so John, can I throw in a couple of things here?
Yep.
The idea behind this, and John's been working on this towards the tail end of last year. He said, I'd really like to start doing some things live with some people again. And we started kind of just talking back and forth. And this team of 23 is whatever both of us were talking about the beginning of our careers. And I met John in 2001, whenever I hired a mentor to fly out from across the country to come sit in my living room in Arlington, Virginia. And he said, holy cow, you've got a REIA group here with some national figures. These people are really well known, really well respected. Have you ever been to this REIA meeting? And we said, what's REIA? We didn't even know what a REIA was at the time. So we'd been doing a couple of renovations ourselves, but we had no idea that there was an entire community of people out here. So this is really to help people. The team of 23 is trying to get some people that are maybe at the beginning or kind of in the intermediate type stage of their career, and introduce them to a lender, introduce them to a title attorney, somebody that can actually close these properties for you. That way, whenever you go in and you're making an offer on a property, you've actually got some exposure to these people already, and you have maybe a little bit of education from them, or can at least say, hey, I can call my friend Jim and he can set up our closing for us. What's a good day for you? I mean, that's really the kind of thing that kind of tends to push people from the beginning of their career, and at least gives them a little bit of an image that, hey, I've done this before. I've done it with a group of people. And the idea here is to actually walk through a property that John has. So whenever we say we don't have all the details, do you have a property yet that you're thinking of putting these people in, or is that still in the works?
Those of you that have worked with me in the past know that I I spent a lot of time thinking through these things to make sure it's the right deal and the right property. It's the perfect teachable property, one that you can replicate. Because so the answer is no, not yet. I have a few ideas. I mean, we're constantly doing properties. And you know what? Some of it depends on the group of 23. That's what's kind of exciting about this whole thing. With that many people, you can see the makeup of the group. You can see where they are. I mean, we say, really this tends to be more people that are starting out, starting maybe transitioning, thinking about quitting their job, things of that nature. But who knows? Maybe 23 experienced investors come on board and say, hey, let's take this to the next level. And then it would be a different type of property. It might be a reverse exchange. It might be an eminent domain. It might be, non-performing notes to performing notes to foreclosure. I mean, there's so many different ways to go with a smaller, tighter group to get them to where they want to go. So we're not just going to sign up random people. We're really going to look at the background and makeup of people to make this a group that kind of our new REIA, if you will. And see where it goes. And, sometimes you don't know. Sometimes you don't know. For all I know, Justin, there won't be one text and no one has any interest in this, and we'll continue doing online meetings, which we are going to continue to do anyway. So
here's where I'm going to make a little
part.
I want to make a little plea, because whenever John put together this rental portfolio starting in 2009, we actually got it rolling. And was it really 2011 before we got anything going?
It was the first property bought was late 2012.
Wow.
We talked about it, but I couldn't convince any of my dumb investors because everyone was so nervous back then.
Too scared.
The world was coming to an end.
Yeah, you're right. And all of that was a harrowing part of my life as well. There was properties developments that I owned in the Carolinas, and
for all
hanging on by everything. So yeah, it seemed like a risky time, but it turns out that it's some of the best times to actually be doing some development and be picking up properties. So I actually helped quite a bit.
And that's honestly the challenge, Justin. And you live that and I live that. Sometimes when there's opportunity, we're so mirrored in our businesses trying to survive that we know there's opportunity, but we can't capture it because we're still trying to manage ourselves out of the mess that we're in. Right.
Yeah. So we picked
the
up
other
20
thing in this. If you're a buy, renovate, sell guy or whatever, try to clear up some mental and some capacity to take advantage of these opportunities. I mean, it's so easy for me to say this, but I understand real life. I've lived this for 30 years. I get it. When Justin had developments in South Carolina, and we talked a lot, and I had these 30 plus loans, we knew there's opportunity. We're like, we got to get out from under, to survive this, knowing that if you survive and come out the other side, you're going to be in good shape. And that's kind of what happened, but it's a lot of work and a lot of sleepless nights. And so, you can know about opportunity. The key is, and what my hope is with this group is that not that we know about it, how can we take advantage of it, knowing the challenges that maybe we have in our personal lives, right? How can we overcome that and create enough mental space to say, man, this is opportunity. Folks, I'll give you one example. I've not heard from a source at a bank for 5 years. I got a call last week from a banker, from a source that I've known for a long time, hadn't heard from in a long time. He said, hey, I might have a couple non-performing loans for you. Are you interested? I haven't had that phone call in a number of years. And my answer, of course, is yes, bring them on. Let me take a look. Let's see what's going on. So those are the kind of things you got to be ready for that are coming.
Yeah. So, and back then, whenever we did this before, we built out 20 some odd properties, but if we would have had a handful more people, we probably could have gone to 40 or 50.
No doubt.
I mean,
or if we started a little bit earlier.
Yeah.
Because I know guys that made fortunes.
Yeah. So that's the ask right now, is if some people are interested in this, if we can get people out that are again, you don't have to be at the beginning of your career. It helps if you don't have a lot of bad habits already. But if you've got some contacts already and you want to team up with some people, I'm a big believer that you can do more as a team than trying to do everything as a lone wolf. You and I are both probably seeing a couple of these emails that are coming in. So it's good that we're hearing from people already.
Yep.
I definitely want to just extend that offering. If you want to know just some more details, text the number that goes right to John.
Yep.
Profitable Property at Gmail as well. Be happy to give you some more details.
Again, we thank everybody for joining us tonight, and you got our numbers. I'm still doing some mentoring out there with folks, 3 1-hour sessions. If you have interest in that, text me. If you have interest in this 23, text us. We're out doing deals and properties, and we thank you for joining us here tonight. Hopefully that some of this was helpful. You got a little nugget or two that you can apply to your business this week, and we can all keep moving forward. Justin, I thank you. Thank you for stepping in last month. Thank you for helping out this month, and we'll keep moving forward with everybody. Thanks so much.
All right, we got one last question here, if we can, before we sign off. Anthony already asked. Anthony Fears is saying, "What's the requirements for the team of 23?"
Anthony, the requirements are. I mean, you always hear the same thing. Good attitude, interest in real estate, things of that nature. It's not going to be 22 wholesalers. It's going to be a variety of people with different interests and different specific targeted goals. So as we get closer, Anthony, if you're interested, let us know, and we'll send you some more information. Maybe even hop on a phone call with you. But it's people. Really, the requirement is people that have a strong desire to see growth this year in real estate investment. How's that for a little mission statement? That's really what it is. I want people. Now, that doesn't mean. We're not going to say, hey, you have to have $50,000 available capital. Or I read the other day where some scam out in Mormon country in Utah, the whole seminar was getting people to up their credit line to buy expensive courses. It's none of that. It's for people that are really interested in real estate investment and want to be a team of smaller to gain resources, to gain some education, to really build some connections in this business that can help you get to where you want to go. And I don't know where that is quite yet, but hopefully that helps a little bit.
Yeah, hopefully that helps answer that. But yep, we are going to try to stick to the time here. Yep. So I go ahead and sign off, everybody. Thanks for coming out again, and let me just say thank you for everybody who signs up for these each month. It helps us gauge the topics that are interesting. So I know we often ask you, please sign up and let us know if you're going to be joining us tonight. Tonight we had over 100 people across LinkedIn, Facebook, and YouTube. So it was great to see everybody, and look forward to hearing from some of you.
Thanks. Thank you, Justin.
All right. Thanks, everybody.
Soon. Bye.